All right, as promised, our friend Harvey Bienenstock, our resident CPA here on the show, is going to try to help you out with tax questions because we're approaching tax season. Things change every year. What do you need to know? What should you be aware of? Harvey, first of all, thank you. We really appreciate you being here this year.
I appreciate it. But as the resident CPA, do I have to pay rent?
No, we're going to let that go this year. This will be a gift. You don't have to declare it as a gift either.
Thank you.
We'll figure something out. So let me go to Ron. I understand we have a caller first. Now I got a bunch of texts I want to get to. Ron, what's your question for Harvey?
My question is about life insurance. I have a life insurance policy, and the dividends, they're sending me slips for the dividends and the interest on the dividends. And the policy was taken out in 1970. And I understand that pre-1982, there's a different taxation on life insurance. And it says that the accrued value of the policy shall never be taxed. And so my question is it taxed? They're sending me slips for it.
Okay.
And the slips call it income.
Okay.
I'm retired, so it's not income.
Okay, let me get to Harvey. Harvey, so he's talking about a life insurance policy that has interest and credit or whatever. What do you do with that?
Well, first of all, life insurance, under most circumstances, is the face value of the policy is not taxed. And usually the premiums are not deductible. So if you buy life insurance and you pay the premium and you die, whoever gets the beneficiary amount will not be taxed on that. However, there's usually a cash value on these plans. Mm-hmm. So if you decide you're going to cash out the insurance before you die because you need the money, then there's a cash surrender value, and that will become free to you. However, since there is a cash value and it increases every year, they take part of your premium, they invest it in an investment account, and the interest or income earned on that is taxable to you. Okay. Because your value is increasing. You are getting interest not on your contribution, but on whatever you put in to the investment account, so it is taxed. So there is, when they say it is not taxable, that's on the face value. On the investment income, unfortunately, you're getting money, you can cash it out, and therefore, when you die, it's either the greater face value, and therefore that's why it's taxed.
Okay, so if you cash the cash surrender value, should you decide that you need that money, is taxable or not?
The amount it's not taxed because you're being taxed on the income it's earned. The premium that you put in was never deducted, so that if you get it back, it's not going to be taxed. Okay. But the interest that you've earned on that premium, because they put it into a segregated investment account, has been increasing, and therefore you pay tax on it. So when you take it out, it's already been taxed.
My eyes are rolling already. Ron, thank you. I hope that helps. Let me go to this text, Harvey, which says, "Hello, I'm a first-year business owner, an independent worker. This year I made $50,000 in revenue, but had $55,000 in business expenses. Do I need to pay TPS TVQ this year? How is this offset or calculated? I collected my TPS and have it ready to pay, but do I need to?"
Well, if you've collected the TPS, it means that you've registered. First of all, if you're a first-year business owner, you may or may not have registered to collect the TPS and TVQ. You only have to register when your gross income is over $30,000 over 4 quarters. So if you didn't know how much money you were going to make, maybe you didn't register. But if you forecast that you were, then you've obviously registered. So when you've registered for the TPS TVQ and you've collected it, now you have to file a return by the end of March, which declares the money you've collected and the credits that you're going to claim on your inputs with things you've bought. So therefore, yes, your TPS TVQ. Now for your income tax return, if you are in business and you've incurred a loss, that loss is deductible against any other sources of income, unless you increase the loss by use of home expenses. If you're going to deduct your home office, you cannot create a loss which is deductible. You're limited to the amount of income you've earned. So if you've made $50,000 income, you've lost $55,000 on your business, you have a $5,000 loss, you can deduct it all against your income, which is not advisable because the first $15,000 is free anyway. So I would deduct maybe $35,000 of loss and save the rest for future years.
Okay, there you go. Thank you for that. Let me go back to the phone. Donna is on the line. Donna, what's your question for Harvey?
Hello, hi. My question is, if you sell a property that is not your main property, so a secondary property in the U.S., and when you sell it, they withhold a 20% tax, like a foreign tax. and you pay that, right? So and then you file your taxes in the U.S. and do you have to file do you have to declare it here in Canada as a gain?
Okay, so first of all, as a U.S. property, whether it's a principal residence or a secondary property, you still have to pay tax on it. The U.S. only has a rollover provision, so if you sell a property and made a profit of over $250,000, if you buy another property within a specified time period, I think 6 months, you can roll over the gain to the next property. But all property tax, now assume you didn't buy another property, you have to declare the sale of that property on a U.S. 1040-NR, which is your non-resident return. There you pay your U.S. tax to the IRS. And the tax you pay is going to be offset by the amount that was withheld, I think, on Form 8288 at the lawyers on the closing. Now, usually the U.S. tax is not 20%; it's either 10 or 15, depending on the amount. I think over like 500,000, I think it's like 15%. However, when you file your IRS return, you're going to either the final amount will be determined on that return. You're either going to get a refund or have to pay. Chances are you're not going to have to pay because you have a cost base. So I don't know how much of your profit. In Canada, it's a little different because, not different. Here you have to file any profit on any property that you've made.
No matter what country you made it in?
No matter what country. Because as a resident of Canada, you pay tax in Canada on your worldwide income.
Okay.
Now, in Canada, you will declare your income. If you've owned a property for less than 1 year, this is a change to the federal government, then they're going to pay tax on income and not capital gain. So they consider it to be an income if you were almost like a flipper if it's less than a year. In Canada, you will file your tax return, pay your Canadian and Quebec taxes, but deduct the taxes you pay to the U.S. as what's called a foreign tax credit. So chances are you'll get all your money back, apply it on your federal return, and then whatever's left will be applied on your Quebec return. So you're not paying double tax, you're just paying it in different places.
Good enough. Let me get to this one. I want to squeeze as many as we can in here. Good afternoon. I'm 65 years old, still planning to work another 5 years. Should I take my pension now or wait until I'm 70? That's from James.
What age, 65?
He's 65 now.
I would absolutely take the pension for various reasons. Eric, as you know, Aaron, if you die, the money's gone unless you have a spouse. Second of all, if you wait, you are going to get an increase in pension of about 0.6% per year for waiting, which is you're going to get like 7 or 8% more a year, but you're losing 92% of the pension by not taking it.
Right.
Other thing is Quebec just passed a rule whereby in the past you had to keep contributing to the Quebec pension even if you were collecting a pension. So if you're working at a job, you were forced to pay into the Quebec pension plan. Your boss had to match it, and for an $8,000 contribution, your pension would go up about $400 a year. So it was not a very good investment, but Quebec pension was making out like bandits. The rules were changed, I believe, to entice people to come back into the workforce. Now, if you are collecting a pension at 65, you can apply to the boss to not withhold any QPP. Tell the Quebec government, the QPP, that I am not paying anymore, and your pension contributions will stop. So you're going to save, up to $8,000 a year. Your boss will save $8,000 a year, and you're ahead because there was never an option in Quebec. It was in Canada. If you were collecting a pension at 65, you didn't have to keep contributing. In Quebec, you did. It was very unfair.
And that starts at age 65. That
if
option.
If you are collecting at 65, yes, you can't. If you're collecting at 60 to 65, they won't give you that break, but you have to be 65. And interesting point, Aaron, the contributions that you make to the Quebec pension plan off your paycheck are not deductible on your Quebec return as a credit or a deduction. So even though you're going to be paying tax on the pension you collect, you don't get a deduction for the money you put in. How do you like that?
I don't like that at all. When do you have to file final taxes upon the death of a taxpayer? That's from Maria.
Well, the rule is it's the later of April 30th of the year following death or 6 months following the date of death. So if somebody died in, say, September, they'd have to file by April 30th. If they died in December, they'd have to file by June 30th.
All right. So right to the point. All right, let me go back to the phone. James is on the line. James, what's your question for Harvey?
My question is, what, if any, obligations do we have for remittance of my TFSA information?
What, your TFSA information?
So tax-free savings.
Well, the only time you have to do that is if you've over-contributed. The government will say if you put too much money in over what you were allowed, and you weren't supposed to. Your limit is $7,000 this year, and if you put in more, they will tax you at 1% per month for how much for the extra, because you're making money tax free, so you're getting a benefits that are going to make you pay. So if you have in fact over contributed, what you can do is remove the over contribution immediately, and therefore stop the clock, but do file the return for saying how many months you were over, and it's 1% per month.
Okay. James, thank you for the call. Carolyn, what's your question
But there's
for
no
Harvey?
tax on the gains, it's just the over contribution.
Carolyn, are you there?
Yeah, I'm here.
Okay, go ahead. Yeah.
Yeah. I have a situation where I got charges from the government saying I didn't report certain income. The bank, the Laurentian Bank, had not sent me any checks or any T4s or 5s, whatever it is they send, saying that I earned RIF money. I never got any money. I never got any T4s. I paid the government the charges, but I since then have received the money that they said they had sent me. They had my right address, my right phone number. I have no idea why it didn't come to me. My husband had the same situation from the same bank, and I don't know how to get the money back from the government that I paid, because I never received, or can I even get the money back from the government, because I never received any T4s or 5s or the money until now, which is from a couple of years ago.
Okay, well, first of all, there are two aspects here. One is the money, and the other is the tax reporting slip. Okay, the fact that you received an assessment for undeclared income, first of all, the government gets that money. They know about it because they got a copy of the slip that the bank issued. The only way they would tax you was if the bank told them that they had paid you a RIF withdrawal. The fact that you did not receive the slip doesn't mean that the slip wasn't issued, unfortunately. So therefore, the fact that you got the money, maybe there was a change in address, I don't know what happened, but this tax reporting slip was there. You didn't get it, unfortunately. Now, you can try to apply for relief by going to the bank and saying that, can you confirm that there was the wrong address, I didn't get the slip, and then maybe you'll get a break. But you probably got the money in your bank account, because you were required to make the withdrawal. So you have a pretty weak argument, because you got the money, and somehow you didn't get the slip and didn't report it. So unfortunately, you can try to apply for relief, but that's a process, and I don't know if you're going to win.
Carolyn, I thank you for the call. Harvey, let me go to this text, which says, hello, is there any deduction/credit for an informal caregiver? Is there a form that needs to be filled out? The care is given to an elderly patient. That's from Dawn.
Normally, you have to make income to get a deduction. Informal caregivers, you can apply for what's called an attendant expense, up to $10,000 a year. It doesn't have to be a medical professional. But it helps if this person is informed. What they should have done is to apply for what's called a disability tax credit form, called on a T-2201, where if somebody is infirm under one of 6 circumstances, either they're blind or can't hear or can't walk or can't eat, et cetera, if you apply to the feds, and you can do it online now, and certified by a medical professional, you will get called a disability tax credit, which gives you an extra like the $8,000 deduction each year on the feds, maybe $4,000 on Quebec. And having that certificate means that you need help, and you can deduct a lot more expenses, including nursing home expenses, et cetera. So I would suggest if somebody does need that attendant expense, they should get that credit form. Otherwise, they're limited to $10,000 per person for the attendant medical expense deduction.
Okay. Next text. My question is about the tax brackets. As a self-employed taxi driver for the first time, my net for 2023 has surpassed the $50,000 mark. That's because of inflation. My income has gone up, but the cost of living has surpassed my income. Has the tax bracket been raised, or will I continue to be gouged by the government for the money I am not making anymore due to inflation?
Well, the good news is that even at $50,000, you are on the lowest tax bracket. I mean, on the feds, up to $49,000. For Quebec, it's $51,000. You're still paying the 15%. Okay. Anything over, it's 19%. On the feds, anything under $53,000, you're still paying 15% less the deduction. So even though you think you're paying a lot of tax on $50,000, you're still at the lowest tax
rate. Okay. Back to the phone. Joe's on the line. Joe, what's your question? Joe, are you there?
Yes.
Go ahead.
How are you? Okay, my question, I hope I say it right. I'm working for this company, and I have a fonds pension. And now they change insurance company, and now they're dealing with Desjardins. Now, as of December, I received from Desjardins like the T4 slip there of because now they put it into arrears. But in January, they transferred all the money to Desjardins, which I have in Fonds Pension. Am I supposed to get a T4 slip for that, for the 2023 income tax, or I have to wait until next year?
I doubt that it's taxable. If you've gone from one pension plan to another, and you didn't take the money out, but it's just being reinvested at another investment place. No, if it's still there, it's just a direct transfer, and therefore there's no tax event because it's still invested in a pension plan, and there's no tax on the transfer. There is on any withdrawals. So that's the only thing you have to worry about.
All right. How about this one, Harvey? Someone asking, if you move permanently to the U.S., do you still collect provincial and federal Canadian pensions?
Yes, you do. And in fact, there'd be a withholding tax. I think it's 15% on the pensions. So that you would be not paying federal, you don't pay taxes in Canada. In the U.S., probably there is a tax treaty, Article 8 on the tax treaty, that says the maximum tax on any pensions on a foreign jurisdiction is 15%. So you would pay tax in the U.S. on 15%. Now, you could argue that the Quebec pension that you're getting is partly the contributions you put in. So therefore, you'll say, okay, I collected X amount, but part of that was my contributions, so I'm only paying tax on the difference. And therefore, again, you would get a foreign tax credit on your U.S. return, but you would try to reduce the tax by saying part of the money's mine.
All right.
But no Canadian tax, only U.S.
Sandra on the line. Sandra,
there's an advantage. If you have an RRSP, you would go down, you would collapse it, pay the tax here, and then stop paying any tax in future. But that's another situation.
Okay. Sandra, what's your question for Harvey?
Hi, thanks for taking my call. I have an adult son with an intellectual disability, and we set up an RDSP for him several years ago. Given he's an adult now, he also receives Social Solidarity. Does the RDSP that we're growing for him for when we're no longer here have an impact on his Social Solidarity now?
When you say you're not here anymore, what does that mean?
Well, when I pass away, right? So we set up this RDSP to put some money aside for my son for when we're no longer here to take care of him. But being an adult, he also receives Social Solidarity from Quebec.
That's right.
So I'm worried. Well, my question is, the little nest egg we're putting aside for him, does that impact his Social Solidarity, or is the RDSP sheltered from that?
Well, right now it doesn't. I mean, this plan is like an RRSP, but it's specifically for disabled children. And you're allowed to put in a certain amount every year, and that's deductible to you. It's not taxable. It's like an RRSP. There is no implication now, but when he starts taking money out, it will be considered income like an RRSP is. But again, the Social Solidarity, Schedule D on the Quebec return, which replaces the QST credit, that it depends on the income of an individual. I think he collects it anywhere up to like $40,000. So if his income is going to be less than $40,000 and he follows the form, then I think it won't impact the amount that he receives from the Schedule D Quebec Solidarity credit.
Okay. Sandra, thank you. Harvey, how about this text? Says, good afternoon. If I lived in Ontario for 3 months while working and then lived in Quebec while working for 9 months of the year, which province do I submit my taxes to? Do we follow the rule where it's where you're living on December 31st? I'm confused. Thank you.
Yeah, that rule is wherever you live on December 31st is the place that you pay the province that you pay your taxes to. And what will happen is that when you receive your T4 slip from your employer, you may get 2 slips. You may get one for the Quebec residency where they deduct the Quebec tax, and you may get a second slip from the income that you earned in Ontario where they only withheld federal tax. On your federal return, you will declare your income and the taxes withheld, and you will transfer the amount off. There's an eligible transfer, I think like about 25% off the federal tax to your Quebec tax return. So that when you file your federal return, you'll have a reduced federal tax because you're not paying to Ontario, and whatever refund or tax will be on your federal return, and you'll file a Quebec return where you declare all your income in Canada, but you will have whatever taxes were withheld plus what's called the transfer from your federal return. I think it's 45% of your federal tax goes to the Quebec return.
Okay. And then finally this, hi, I'm employed as a delivery person at a restaurant. Can I deduct my car expenses and gas? Thank you.
The answer is yes. I mean, again, the universal rule is that you can deduct any expenses you have incurred to earn income. So if you are required to pay certain expenses in order to generate that income, then you are allowed to deduct it.
Okay.
And obviously, as a driver, and you're paying the cost of performing that duty, then you certainly get a deduction.
All right. Listen, we're out of time. I thank you again for everyone I couldn't get to, and there are many more text messages here. I apologize. Maybe we can try to do this again. Harvey, what's the tax deadline this year?
Deadline, April 30th, unless you're self-employed, in which case it's June 15th, but the weekend's June 17th.